Many thanks for joining us. Welcome to Business Incorporated. I am BC Adebayo. Coming up on today's program, South Africa's President Cyril Ramaphosa unveils economic recovery. Zimbabwe expects average annual inflation to slow to 134% in 2020. And Africa's top 50 most valuable brands could lose up to 12% of brand value as the COVID-19 pandemic wreaks havoc on the global economy. Let's begin the show right away. And markets were mostly positive at intraday here in Africa, with South Africa's GSE capping 0.63%, while Nigeria's main index gained 0.43% after closing flat on Thursday. The market in Egypt is closed for the week, but ended Thursday negative. Kenya's market also ended Thursday's session negative. And major markets in the Middle East ended the week in the red on Thursday, except the Qatari index, which shed 0.27%. The markets in Saudi Arabia also declined marginally by 0.45%. In the UAE, the Abu Dhabi index shed 0.41%, while Dubai's main index was down 1.06%. And in Europe, the markets advanced this morning, looking to bounce back from steep losses in the previous session, with the rapid spread of coronavirus through the continent remaining on investors' radar. Let's get more from Chelsea Delany at the Frankfurt Stock Exchange. Good afternoon, Chelsea. So it's a brighter day for European stocks after yesterday's steep slide amid record high coronavirus cases in many countries. How are investors assessing the risk at the end of this volatile week?
Well, stocks here in Europe are definitely ending on a bit of a high note. The DAX here in Frankfurt is up about 1% right now. And we're seeing generally still a lot of positivity among investors, even though they are clearly concerned about the rising number of cases and the rising number of restrictions that are being put in place across Europe. This will in particular hit industries like the restaurant industry, hospitality, bars, all of these industries that had already been really struggling. But on the whole, investors are still quite optimistic that the countries will be able to avoid nationwide lockdowns. So that's really helping to temper the market fears, as well as we've seen some positive data on the potential for a vaccine approval coming soon. We heard from Pfizer earlier today that they do plan to submit their vaccine candidate by the end of the year. So that's all really helping to give markets a little bit of a boost on the end of the week.
Now, European automakers saw sales unexpectedly increase 1.1% last month. Now, do they expect sales to keep moving?
Automakers are generally pretty optimistic right now that they will be able to continue this momentum. We've seen many automakers in September posting really double-digit gains. Volkswagen saw sales rise about 14%. This is really coming from Germany and Italy in particular, two countries that have put in place different programs to encourage people, different incentive programs to encourage people to buy cars. So this has helped drive sales up for the first time this year, which is a bit of a surprise. Of course, there is still concern about the number of cases and whether this will lead to more lockdowns. But for now, we've heard from several automakers, including Daimler today, which reported a much stronger than expected third quarter, that they do expect this momentum to last really for the rest of the year, barring nationwide lockdowns.
All right, just before we wrap up our conversation, Chelsea, let's talk about one of Germany's oldest companies, which could soon lose its steel business. I'm talking about the industrial conglomerate ThyssenKrupp, which has been approached by the UK metals group Liberty House about potentially buying its struggling steel business. What's driving this deal?
It's a very difficult time to be a steel producer in Europe, even before coronavirus, which has really impacted the industry quite severely. Steelmakers were dealing with all sorts of headwinds, overcapacity throughout Europe, the rise in trade tensions, tariffs, as well as the cost of transitioning away from energy sources like coal to more renewable sources. So they're facing weak demand and a lot of competition. So Liberty is really hoping that if they buy buy ThyssenKrupp's steel business, that they would be able to reach some sort of scale, some sort of efficiency that would allow them to be a stronger competitor in this market. They're not the only one that are bidding for ThyssenKrupp's steel business. There are other companies here in Europe that would also be interested. But clearly there is a need for consolidation because it's really a tough industry to be in right now.
Thank you, Chelsea. Do have a great weekend. Let's cross over now to London, where Juliana Olayinka will be telling us what major headlines are driving the markets at intraday. Good afternoon, Juliana. Let's kick off with this one from British Airways. Now, that airline has been fined £20 million by the Information Commissioner's Office for a data breach, which affected more than 400,000 customers in 2018. What more can you tell us about this story?
Well, yes, as you said, the story goes back to 2018, where attackers were able to access the database of British Airways, and they managed to gain access to over 420,000 passenger details, and not just names and addresses, but also their full card details, including the expiry date and the CVV numbers. Now, British Airways were actually initially fined £189 million, but because of the COVID pandemic and just how their profits have been dented into nothing, it was reduced to £20 million. Really, the ICO watchdog found that during the time, some of the security measures that BA had in place were not really fit for purpose, and that BA were aware of this, and the fact that the attack managed to happen just showed the flaws in their system. Of course, they've, BA have said on record that they've managed to turn things around, and they've accepted the £20 million fine, and they're hoping that it won't happen again.
All right. Now, Facebook-owned Instagram is to crack down on social media influencers and celebrities who make posts without telling followers when they have been paid to do so. And that follows an investigation by the Competition and Markets Authority. But what actually led to that investigation in the first place?
Well, here in the UK, clear labelling of incentivised posts is required by law. So you cannot post something if you've been asked to do it without letting people know that you've been doing it. This has been an ongoing discussion here in the UK, and I presume across the world for millions of years. Of course, if you're lucky enough to be one of those people that have over 1 million followers on Instagram, then a lot of brands want you to advertise their products. And as we know, a lot of young teenagers, even people younger than that who shouldn't be on Instagram, will look at what a lot of these influencers are posting, and because they're endorsing that product, they may buy it. But of course, if somebody's been paid to endorse, that's slightly different. Perhaps the reason why you're saying the product is great is because you've been paid to do so. So the CMA have been on this for a while. They want it to be abundantly clear. A couple of months ago, we already had some pretty high-profile celebrities here in the UK who committed to doing it themselves. So you do see some people say, you know, this post is paid or #ad. And Facebook Ireland, I believe they kind of oversee Instagram here in the UK. They've committed to a series of measures which have been put forward by the CMA to ensure that when somebody does have a look at a post on Instagram, if it's posted by one of the influencers, they can tell whether they've been paid to do it or they're doing it because they genuinely like the product.
All right, Juliana, one last question. Now, it's a few hours before the new lockdown rules take effect in London. How are the markets bracing up?
Well, it's interesting. We had a little bit of breaking news here in the UK, which was the Prime Minister Boris Johnson has said to businesses they should get ready for a no-deal Brexit. That has turned things completely around. COVID dominates one day, Brexit dominates another, and Brexit is going to dominate discourse throughout the weekend. Surprise, surprise, that's cheered investors here. They're happy that at least there's some sort of firm footing. The FTSE All-Share at intraday is up 1.19%. The FTSE 100 is up by 1.127%. And the FTSE 350 is up by 0.56%. In currencies, the British pound is also up on the US dollar by 0.38%, up on the euro by 0.27%, and up on the Japanese yen by 0.17% at intraday, Bissy.
Thank you, Juliana. Do have a wonderful weekend, and always remember to stay safe. Right, stocks across Asia Pacific were mostly down at the close of Friday amid dampened sentiment on the coronavirus front. Mainland Chinese stocks were mixed by the close, with the Shanghai Composite up 0.13% and the Shenzhen Component declined 0.68%. In Hong Kong, the Hang Seng Index jumped 1.04% by the afternoon. And in the U.S., stock futures were slightly high on Friday as stocks attempt to snap a three-day losing streak. Futures reversed losses as Pfizer said it would apply for emergency use of its coronavirus vaccine as soon as it reaches certain safety milestones that it expects to have in late November. Dow Jones Industrial Average futures added 61 points. The S&P 500 futures were also up, as well as the Nasdaq 100 futures. Away from the markets now, the South African government has committed 100 billion rand, or about $6 billion, to support and create over 800,000 employment opportunities over the next 3 years. President Cyril Ramaphosa announced this at a joint sitting of the House of Parliament in a hybrid session on the Reconstruction and Recovery Plan aimed at steering the country back to desirable growth levels in the aftermath of the coronavirus pandemic. Let's listen to him.
This virus, coronavirus, will remain part of our lives for some time to come. And therefore, we need to adjust to this new reality and also to this new normal in all areas of our lives. Firstly, we are embarking on a massive rollout of infrastructure throughout the country. Infrastructure has immense potential to stimulate investment and growth, to develop other economic sectors, and to create sustained employment, both directly and indirectly. We have developed a robust pipeline of projects that will completely transform the landscape of our cities, of our towns, and indeed of our rural areas. Our second priority intervention is to rapidly expand energy generation capacity. Our third key intervention is an employment stimulus to create jobs and to support the livelihoods of our people. We will therefore be extending the special COVID-19 grant by a further 3 months so that we assist our people who are in distress.
Zimbabwe expects its average annual inflation to slow to 134% in 2020, more than half the central bank's previous forecast. The country is grappling with its worst economic crisis in more than a decade, with runaway inflation of 659.4% year-on-year in September and severe shortages of foreign currency, food and medicine. The Finance Ministry attributes the slowdown in inflation to a deepening of the foreign currency auction market, which is expected to aid exchange rate stability. The central bank had previously forecast 2020 annual inflation at 300%. But we'll be talking about COVID-19 and the global economy when we return in just a moment. Please stay with us. Welcome back. On Wednesday, the Managing Director of the International Monetary Fund, Kristalina Georgieva, announced that the crisis from COVID-19 can lead to a global loss of $28 trillion in the next 5 years. According to the IMF boss, while there is tremendous uncertainty around forecasts, the fund projects a partial and uneven recovery in 2021, with growth expected at 5.2%. But let's talk about how all of this affects Africa with the founder and chief narrative officer at Clio's Advisory in the UK, Mr. Ted George. Good afternoon, Mr. George. Thank you for joining us on the program today. Now, it's not the first time the IMF or even the World Bank will be painting a gloomy picture about the effects of the pandemic on the global economy. But how badly has Africa been affected, and which countries have fared better or worse during the crisis?
Well, I think it really depends where you look in Africa, because the reality is that the IMF is due to bring out its next global outlook next week. But back in June, they were forecasting a 3.2% contraction this year. And that is huge. I mean, that represents, two or three economies all added together in Africa. The reality is COVID hasn't hit the population as hard as, let's say, Western Europe or South Asia or Latin America. But what we have seen is very limited fiscal space by the African governments to be able to respond to the drop in demand. So the countries that have really been affected, oil-dependent countries, Nigeria, for example, is expected to shrink by 5% this year, Equatorial Guinea by 8.1%, and Angola is expecting a fifth consecutive year of contraction in GDP of around 4%. Also, economies which are dependent on tourism. Mauritius is expected to be down 12%, Seychelles by 14%. No one can travel to these destinations. But what is interesting is the countries that are not dependent on a single commodity, which are a bit more diversified and which are integrated into a regional market, are faring relatively well. If we look at West Africa, for example, Ghana is overall expected to grow by around 1.5% and Cote d'Ivoire by 1.8% this year. So these are initial predictions, of course, but it just shows that if you have a diversified economy, you can withstand the impact of COVID a lot more than if you're dependent on a single commodity export.
Now, heavy spending by governments has pushed up the level of debt, which is forecast to reach 100% of GDP next year. What has been done to ease the debt burden for African countries?
Well, there have been a lot of different initiatives from the very start of the year, because we've actually seen fiscal deficits rising sharply in African governments from around 4% last year of GDP to around 8% this year. The IMF itself has approved over $280 billion in financing, more than a third of that since March. We've also seen the G20 have agreed to freeze debt repayments for the poorest nations beyond the end of this year. And there is the Debt Service Suspension Initiative, the DSSI, which has 28 countries in sub-Saharan Africa getting around $5 billion of relief. And I know the IMF is actually pushing to extend that beyond the end of this year to the end of 2021, which would give another $5 billion of relief. The Paris Club is also, of private creditors, has also agreed to suspend debt repayments. But I think where there's a real concern is about Chinese debt, because there's just not really much certainty about how much it is. It's estimated around $150 billion, and around 3/4 of debt repayments owed by Africa are actually to China. So this is a real question. How big is the debt? But certainly going forward, there needs to be more debt relief offered to African countries to get through this crisis.
Now, with all of this now, are we likely to see an economic recovery in 2021? And what measures are being proposed to achieve this?
Well, the IMF is expecting a rebound of around 3.4% growth next year in 2021 for Africa, which should help fill up some of the drop from this year. But the reality is we've seen a lot of short-term measures which are very costly. Ultimately, the priorities, number one, is to continue measures to protect lives and livelihoods. This means the different health regimes, the curfews, the social distancing, and also credit guarantees, wage subsidies, things to keep businesses on life support so they can get through this drop in demand. The real thing is what is needed in the medium and long term. There needs to be more public investment to boost growth. It can't just be propping up salaries. And this is going to require more lending and more borrowing. And so really the big question here is about debt. There needs to be more debt relief. This is being proposed by the IMF and World Bank, but it really needs to go beyond that. It needs to be private lenders. It needs to be investors as well, who are going to give a bit more slack to these African economies so they can grow. But I think the important thing to bear in mind here is even though the biggest economies have taken the largest hit, South Africa, Nigeria, Kenya, a lot of the smaller economies are actually relatively undeveloped. They're not too heavily dependent on technology. And in fact, they're managing relatively well through the crisis. So there is a good upside in terms of growth if some degree of normality can return by the middle of next year.
All right, we'd like to thank you, Founder and Chief Narrative Officer, Clio's Advisory UK, Mr. Ted George. Thank you for joining us on the program.
My pleasure.
Now, Africa's top 150 most valuable brands could lose up to 12% of brand value cumulatively as the COVID-19 pandemic wreaks havoc on the global economy. And that's according to the latest Brand Finance Africa 150 2020 report. This represents a drop of $60 billion compared to the original valuation date of January the 1st, 2020. South Africa's telco MTN was crowned as the continent's most valuable brand, despite recording a 1% brand value loss to $3.3 million. The third most valuable telecoms brand and the 12th most valuable in the ranking is Kenya's Safaricom, with a brand value of $970 million. Vodacom is the strongest brand in Africa, with a brand strength index score of 89.5 out of 100 and a corresponding AAA brand strength rating. And oil prices are down today due to concerns that a spike in COVID-19 cases in Europe and the United States is curtailing demand in two of the world's biggest fuel-consuming nations, or regions rather, while a stronger US dollar also added to pressure. Brent crude futures for December dropped 0.74% to $42.84 a barrel in early trade, while US WTI crude futures for November delivery slid 0.56% to $40.73 a barrel. A technical committee of OPEC Plus ended a meeting on Thursday expressing concerns about rising oil supply as social restrictions to curb the spread of COVID-19 limit fuel usage. Gold slipped on Friday and looked set to post its first drop in 3 weeks as the dollar held firm, while additional U.S. fiscal stimulus appeared unlikely before the presidential election. Spot gold was down 0.1% to $1,906.80 an ounce, while U.S. gold futures were up 0.2% at $1,912.20 an ounce. Gold has gained nearly 26% so far this year, helped by stimulus from government and global central banks to revive their economies. Silver was down 0.2% at $24.26 an ounce and was down 3.5% for the week. Platinum was down 0.1% at $863.39, while palladium rose 0.1% to $2,354.95. And that's our program today. Thank you for watching. I am Bisi Adebayo.